price of my house from minute to minute? Do I prevent its value from rising over time? The only possible answer to these questions is of course not. And you should view your portfolio the same way. Over a 10 or 20 or 30-year investment horizon, Mr. Market's daily dipsy-doodles simply do not matter. In any case, for anyone who will be investing for years to come, falling stock prices are good news, not bad, since they enable you to buy more for less money. The longer and further stocks fall, and the more steadily you keep buying as they drop, the more money you'll make in the end. If you remain steadfast until the end. Instead of fearing a bear market, you should embrace it. The intelligent investor should be perfectly comfortable owning a stock or mutual fund, even if the stock market stopped supplying daily prices for the next 10 years. Paradoxically, you will be much more in control, explains neuroscientist Antonio Damasio, if you realize how much you are not in control. By acknowledging your biological tendency to buy high and sell low, you can admit the need to dollar-cost average, rebalance, and sign an investment contract. By putting much of your portfolio on permanent autopilot, you can fight the prediction addiction. Focus on your long-term financial goals and tune out Mr. Market's mood swings. When Mr. Market gives you lemons, make lemonade. Although Graham teaches you that you should buy when Mr. Market is yelling, "Sell!" there's one exception the intelligent investor needs to understand. Selling into a bear market can make sense if it creates a tax windfall. The U.S. Internal Revenue Code allows you to use your realized losses, any declines in value that you lock in by selling your shares, to offset up to $3,000 in ordinary income. Let's say you bought 200 shares of Coca-Cola stock in January 2000 for $60 a share, a total investment of $12,000. By year-end 2002, the stock was down to $44 a share, or $8,800 for your lot, a loss of $3,200. You could have done what most people do, either whine about your loss or sweep it under the rug and pretend it never happened. Or you could have taken control. Before 2002 ended, you could have sold all your Coke shares, locking in the $3,200 loss. Then, after waiting 31 days to comply with IRS rules, you would buy 200 shares of Coke all over again. The result? You would be able to reduce your taxable income by $3,000 in 2002, and you could use the remaining $200 loss to offset your income in 2003. And better yet, you would still own a company whose future you believe in, but now you would own it for almost 1/3 less than you paid the first time. With Uncle Sam subsidizing your losses, it can make sense to sell and lock in a loss. If Uncle Sam wants to make Mr. Market look logical by comparison, who are we to complain? News you could use. Stocks are crashing, so you turn on the television to catch the latest market news. But instead of CNBC or CNN, imagine that you can tune in to the Benjamin Graham Financial Network. On BGFN, the audio doesn't capture that famous sour clang of the market's closing bell. The video doesn't home in on brokers scurrying across the floor of the stock exchange like angry rodents. Nor does BGFN run any footage of investors gasping on frozen sidewalks as red arrows whiz overhead on electronic stock tickers. Instead, the image that fills your TV screen is the facade of the New York Stock Exchange, festooned with a huge banner reading, "Sale! 50% off!" As intro music, Bachman-Turner Overdrive can be heard blaring a few bars of their old barn burner, "You ain't seen nothing yet." Then the anchorman announces brightly, Stocks became more attractive yet again today, as the Dow dropped another 2.5% on heavy volume, the fourth day in a row that stocks have gotten cheaper. Tech investors fared even better, as leading companies like Microsoft lost nearly 5% on the day, making them even more affordable. That comes on top of the good news of the past year, in which stocks have already lost 50%, putting them at bargain levels not seen in years. And some prominent analysts are optimistic that prices may drop still further in the weeks and months to come. The newscast cuts over to market strategist Ignaz Anderson of the Wall Street firm of Ketchum and Skinner, who says, "My forecast is for stocks to lose another 15% by June. I'm cautiously optimistic that if everything goes well, the stocks could lose 25%, maybe more." "Let's hope Ignaz Anderson is right," the anchor says cheerily. "Falling stock prices would be fabulous news for any investor with a very long horizon." And now over to Wally Wood for our exclusive AccuWeather forecast. Investment Owner's Contract. I hereby state that I am an investor who is seeking to accumulate wealth for many years into the future. I know that there will be many times when I will be tempted to invest in stocks or bonds because they have gone or are going up in price, and other times when I will be tempted to sell my investments because they have gone or are going down. I hereby declare my refusal to let a herd of strangers make my financial decisions for me. I further make a solemn commitment never to invest because the stock market has gone up, and never to sell because it has gone down. Instead, I will invest per month, every month, through an automatic investment plan, or dollar cost averaging program, into the following mutual funds, or diversified portfolios. I will also invest additional amounts whenever I can afford to spare the cash, and can afford to lose it in the short run. I hereby declare that I will hold each of these investments continually through at least the following date, which must be a minimum of 10 years after the date of this contract. The only exceptions allowed under the terms of this contract are a sudden pressing need for cash, like a healthcare emergency or the loss of my job, or a planned expenditure like a housing down payment or a tuition bill. I am, by signing below, stating my intention not only to abide by the terms of this contract, but to reread this document whenever I'm tempted to sell any of my investments. This contract is valid only when signed by at least one witness, and must be kept in a safe place that is easily accessible for future reference. Chapter 9. Investing in investment funds. One course open to the defensive investor is to put his money into investment company shares. Those that are redeemable on demand by the holder at net asset value are commonly known as mutual funds or open-end funds. Most of these are actively selling additional shares through a corps of salesmen. Those with non-redeemable shares are called closed-end companies or funds. The number of their shares remains relatively constant. All of the funds of any importance are registered with the Securities and Exchange Commission, SEC, and are subject to its regulations and controls. The industry is a very large one. At the end of 1970, there were 383 funds registered with the SEC, having assets totaling $54.6 billion. Of these, 356 companies with $50.6 billion were mutual funds, and 27 companies with $4 billion were closed-end. There are different ways of classifying the funds. One is by the broad division of their portfolio. They are balanced funds if they have a significant, generally about 1/3, component of bonds, or stock funds if their holdings are nearly all common stocks. There are some other varieties here, such as bond funds, hedge funds, letter stock funds, etc. Another is by their objectives, as their primary aim is for income, price stability, or capital appreciation, growth. Another distinction is by their method of sale. Load funds add a selling charge, generally about 9% of asset value on minimum purchases, to the value before charge. Others, known as no-load funds, make no such charge. The managements are content with the usual investment counsel fees for handling the capital. Since they cannot pay salesmen's commissions, the size of the no-load funds tends to be on the low side. The buying and selling prices of the closed-end funds are not fixed by the companies, but fluctuate in the open market, as does the ordinary corporate stock. Most of the companies operate under special provisions of the income tax law, designed to relieve the shareholders from double taxation on their earnings. In effect, the funds must pay out virtually all their ordinary income, for example, dividends and interest received, less expenses. In addition, they can pay out their realized long-term profits on sales of investments in the form of capital gain dividends, which are treated by the shareholder as if they were his own security profits. There is another option here, which we omit to avoid clutter. Nearly all the funds have but one class of security outstanding. A new wrinkle, introduced in 1967, divides the capitalization into a preferred issue, which will receive all the ordinary income, and a capital issue, or common stock, which will receive all the profits on security sales. These are called dual-purpose funds. Many of the companies that state their primary aim is for capital gains concentrate on the purchase of the so-called growth stocks, and they often have the word growth in their name. Some specialize in a designated area such as chemicals, aviation, overseas investments. This is usually indicated in their titles. The investor who wants to make an intelligent commitment in fund shares has thus a large and somewhat bewildering variety of choices before him, not too different from those offered in direct investment. In this chapter we shall deal with some major questions, viz. 1. Is there any way by which the investor can assure himself of better-than-average results by choosing the right funds? Sub-question: what about the performance funds? 2. If not, how can he avoid choosing funds that will give him worse-than-average results? 3. Can he make intelligent choices between different types of funds, for example, balanced versus all-stock, open-end versus closed-end, load versus no-load? Investment fund performance as a whole. Before trying to answer these questions, we should say something about the performance of the fund industry as a whole. Has it done a good job for its shareholders? In the most general way, how have fund investors fared as against those who made their investments directly? We are quite certain that the funds in the aggregate have served a useful purpose. They have promoted good habits of savings and investment. They have protected countless individuals against costly mistakes in the stock market. They brought their participants income and profits commensurate with the overall returns from common stocks. On a comparative basis, we would hazard the guess that the average individual who put his money exclusively in investment fund shares in the past 10 years has fared better than the average person who made his common stock purchases directly. The last point is probably true even though the actual performance of the funds seems to have been no better than that of common stocks as a whole, and even though the cost of investing in mutual funds may have been greater than that of direct purchases. The real choice of the average individual has not been between constructing and acquiring a well-balanced common stock portfolio, or doing the same thing a bit more expensively by buying into the funds. More likely his choice has been between succumbing to the wiles of the doorbell-ringing mutual fund salesman on the one hand, as against succumbing to the even wilier and much more dangerous peddlers of second- and third-rate new offerings. We cannot help thinking, too, that the average individual who opens a brokerage account with the idea of making conservative common stock investments is likely to find himself beset by untoward influences in the direction of speculation and speculative losses. These temptations should be much less for the mutual fund buyer. But how have the investment funds performed as against the general market? This is a somewhat controversial subject, but we shall try to deal with it in simple but adequate fashion. Table 9.1, shown on the enhancement, gives some calculated results for 1961 through 1970 of our 10 largest stock funds at the end of 1970, but choosing only the largest one from each management group. It summarizes the overall return of each of these funds for 1961 through 1965, 1966 through 1970, and for the single years 1969 and 1970. We also give average results based on the sum of one share of each of the 10 funds. These companies had combined assets of over $15 billion at the end of 1969, or about 1/3 of all the common stock funds. Thus, they should be fairly representative of the industry as a whole. In theory, there should be a bias in this list on the side of better-than-industry performance, since these better companies should have been entitled to more rapid expansion than the others, but this may not be the case in practice. Some interesting facts can be gathered from this table. First, we find that the overall results of these 10 funds for 1961 through 1970 were not appreciably different from those of the Standard & Poor's 500 stock composite average or the S&P 425 industrial stock average, but they were definitely better than those of the DJIA. This raises the intriguing question as to why the 30 giants in the DJIA did worse than the much more numerous and apparently rather miscellaneous list used by Standard & Poor's. A second point is that the fund's aggregate performance as against the S&P index has improved somewhat in the last 5 years, compared with the preceding 5. The fund's gain ran a little lower than S&P's in 1961 through 1965, and a little higher than S&P's in 1966 through 1970. The third point is that a wide difference exists between the results of the individual funds. We do not think the mutual fund industry can be criticized for doing no better than the market as a whole. Their managers and their professional competitors administer so large a portion of all marketable common stocks that what happens to the market as a whole must necessarily happen approximately to the sum of their funds. Note that the trust assets of insured commercial banks included $181 billion of common stocks at the end of 1969. If we add to this the common stocks in accounts handled by investment advisors, plus the $56 billion of mutual and similar funds, we must conclude that the combined decisions of these professionals pretty well determine the movements of the stock averages, and that the movement of the stock averages pretty well determines the fund's aggregate results. Are there better-than-average funds, and can the investor select these so as to obtain superior results for himself? Obviously, all investors could not do this, since in that case we would soon be back where we started, with no one doing better than anyone else. Let us consider the question first in a simplified fashion. Why shouldn't the investor find out what fund has made the best showing of the lot over a period of sufficient years in the past? Assume from this that its management is the most capable and will therefore do better than average in the future, and put his money in that fund. This idea appears the more practicable because, in the case of the mutual funds, he could obtain this most capable management without paying any special premium for it as against the other funds. By contrast, among non-investment corporations, the best-managed companies sell at correspondingly high prices in relation to their current earnings and assets. The evidence on this point has been conflicting over the years, but our Table 9.1 found on the enhancement, covering the 10 largest funds, indicates that the results shown by the top 5 performers of 1961 through 1965 carried over, on the whole, through 1966 through 1970, even though 2 of this set did not do as well as 2 of the other 5. Our studies indicate that the investor in mutual fund shares may properly consider comparative performance over a period of years in the past, say at least 5, provided the data do not represent a large net upward movement of the market as a whole. In the latter case, spectacularly favorable results may be achieved in unorthodox ways, as will be demonstrated in our following section on performance funds. Such results, in themselves, may indicate only that the fund managers are taking undue speculative risks, and getting away with same, for the time being. Performance funds. One of the new phenomena of recent years was the appearance of the cult of performance in the management of investment funds, and even of many trust funds. We must start this section with the important disclaimer that it does not apply to the large majority of well-established funds, but only to a relatively small section of the industry which has attracted a disproportionate amount of attention. The story is simple enough. Some of those in charge set out to get much better than average, or DJIA, results. They succeeded in doing this for a while, garnering considerable publicity and additional funds to manage. The aim was legitimate enough. Unfortunately, it appears that in the context of investing really sizable funds, the aim cannot be accomplished without incurring sizable risks. And in a comparatively short time, the risks came home to roost. Several of the circumstances surrounding the performance phenomenon caused ominous head-shaking by those of us whose experience went far back, even to the 1920s, and whose views, for that very reason, were considered old-fashioned and irrelevant to this second new era. In the first place, and on this very point, nearly all these brilliant performers were young men in their 30s and 40s, whose direct financial experience was limited to the all but continuous bull market of 1948 through 1968. Secondly, they often acted as if the definition of a sound investment was a stock that was likely to have a good rise in the market in the next few months. This led to large commitments in newer ventures at prices completely disproportionate to their assets or recorded earnings. They could be justified only by a combination of naive hope in the future accomplishments of these enterprises with an apparent shrewdness in exploiting the speculative enthusiasms of the uninformed and greedy public. This section will not mention people's names, but we have every reason to give concrete examples of companies. The performance fund most in the public's eye was undoubtedly Manhattan Fund, Incorporated, organized at the end of 1965. Its first offering was of 27 million shares at $9.25 to $10 per share. The company started out with $247 million of capital. Its emphasis was, of course, on capital gains. Most of its funds were invested in issues selling at high multipliers of current earnings, paying no dividends, or very small ones, with a large speculative following and spectacular price movements. The fund showed an overall gain of 38.6% in 1967, against 11% for the S&P Composite Index. But thereafter, its performance left much to be desired, as is shown in Table 9.2, found on the enhancement. The portfolio of Manhattan Fund at the end of 1969 was unorthodox, to say the least. It is an extraordinary fact that two of its largest investments were in companies that filed for bankruptcy within 6 months thereafter, and a third faced creditors' actions in 1971. It is another extraordinary fact that shares of at least one of these doomed companies were bought not only by investment funds, but by university endowment funds, the trust departments of large banking institutions, and the like. A third extraordinary fact was that the founder-manager of Manhattan Fund sold his stock in a separately organized management company to another large concern for over $20 million in its stock. At that time, the management company sold had less than $1 million in assets. This is undoubtedly one of the greatest disparities of all times between the results for the manager and the managees. A book published at the end of 1969 provided profiles of 19 men who are tops at the demanding game of managing billions of dollars of other people's money. The summary told us further that they are young. Some earn more than $1 million a year. They are a new financial breed. They all have a total fascination with the market and a spectacular knack for coming up with winners. A fairly good idea of the accomplishments of this top group can be obtained by examining the published results of the funds they manage. Such results are available for funds directed by 12 of the 19 persons described in the Money Managers. Typically enough, they showed up well in 1966 and brilliantly in 1967. In 1968, their performance was still good in the aggregate, but mixed as to individual funds. In 1969, they all showed losses, with only one managing to do a bit better than the S&P Composite Index. In 1970, their comparative performance was even worse than in 1969. We have presented this picture in order to point a moral, which perhaps can best be expressed by the old French proverb, plus ça change, plus c'est la même chose. Bright, energetic people, usually quite young, have promised to perform miracles with other people's money since time immemorial. They have usually been able to do it for a while, or at least to appear to have done it, and they have inevitably brought losses to their public in the end. About a half-century ago, the miracles were often accompanied by flagrant manipulation, misleading corporate reporting, outrageous capitalization structures, and other semi-fraudulent financial practices. All this brought on an elaborate system of financial controls by the SEC, as well as a cautious attitude toward common stocks on the part of the general public. The operations of the new money managers in 1965 through 1969 came a little more than one full generation after the shenanigans of 1926 through 1929. The specific malpractices banned after the 1929 crash were no longer resorted to. They involved the risk of jail sentences. But in many corners of Wall Street, they were replaced by newer gadgets and gimmicks that produced very similar results in the end. Outright manipulation of prices disappeared, but there were many other methods of drawing the gullible public's attention to the profit possibilities in hot issues. Blocks of letter stock could be bought well below the quoted market price, subject to undisclosed restrictions on their sale. They could immediately be carried in the reports at their full market value, showing a lovely and illusory profit, and so on. It is amazing how, in a completely different atmosphere of regulation and prohibitions, Wall Street was able to duplicate so much of the excesses and errors of the 1920s. No doubt there will be new regulations and new prohibitions. The specific abuses of the late 1960s will be fairly adequately banned from Wall Street. But it is probably too much to expect that the urge to speculate will ever disappear, or that the exploitation of that urge can ever be abolished. It is part of the armament of the intelligent investor to know about these extraordinary popular delusions, and to keep as far away from them as possible. The picture of most of the performance funds is a poor one if we start after their spectacular record in 1967. With the 1967 figures included, their overall showing is not at all disastrous. On that basis, one of the money managers' operators did quite a bit better than the S&P Composite Index. 3 did distinctly worse, and 6 did about the same. Let us take as a check another group of performance funds, the 10 that made the best showing in 1967, with gains ranging from 84% up to 301% in that single year. Of these, 4 gave a better overall 4-year performance than the S&P index, if the 1967 gains are included, and 2 excelled the index in 1968 through 1970. None of these funds was large, and the average size was about $60 million. Thus, there is a strong indication that smaller size is a necessary factor for obtaining continued outstanding results. The foregoing account contains the implicit conclusion that there may be special risks involved in looking for superior performance by investment fund managers. All financial experience up to now indicates that large funds, soundly managed, can produce, at best, only slightly better than average results over the years. If they are unsoundly managed, they can produce spectacular but largely illusory profits for a while, followed inevitably by calamitous losses. There have been instances of funds that have consistently outperformed the market averages for, say, 10 years or more, but these have been scarce exceptions, having most of their operations in specialized fields, with self-imposed limits on the capital employed, and not actively sold to the public. Closed-end versus open-end funds. Almost all the mutual funds or open-end funds, which offer their holders the right to cash in their shares at each day's valuation of the portfolio, have a corresponding machinery for selling new shares. By this means, most of them have grown in size over the years. The closed-end companies, nearly all of which were organized a long time ago, have a fixed capital structure, and thus have diminished in relative dollar importance. Open-end companies are being sold by many thousands of energetic and persuasive salesmen. The closed-end shares have no one especially interested in distributing them. Consequently, it has been possible to sell most mutual funds to the public at a fixed premium of about 9% above net asset value to cover salesmen's commissions, etc., while the majority of closed-end shares have been consistently obtainable at less than their asset value. This price discount has varied among individual companies, and the average discount for the group as a whole has also varied from one date to another. Figures on this point for 1961 through 1970 are given in Table 9.3, which can be found on the enhancement. It does not take much shrewdness to suspect that the lower relative price for closed-end as against open-end shares has very little to do with the difference in the overall investment results between the two groups. That this is true is indicated by the comparison of the annual results from 1961 through 1970 of the two groups, included in Table 9.3. Thus we arrive at one of the few clearly evident rules for investors' choices. If you want to put money in investment funds, buy a group of closed-end shares at a discount of, say, 10% to 15% from asset value, instead of paying a premium of about 9% above asset value for shares of an open-end company. Assuming that the future dividends and changes in asset values continue to be about the same for the two groups, you will thus obtain about 1/5 more for your money from the closed-end shares. The mutual fund salesman will be quick to counter with the argument, but if you own closed-end shares, you can never be sure what price you can sell them for. The discount can be greater than it is today, and you'll suffer from the wider spread. With our shares, you are guaranteed the right to turn in your shares at 100% of asset value, never less. Let us examine this argument a bit. It'll be a good exercise in logic and plain common sense. Question: assuming that the discount on closed-end shares does widen, how likely is it that you'll be worse off with those shares than with an otherwise equivalent purchase of open-end shares? This calls for a little arithmetic. Assume that investor A buys some open-end shares at 109% of asset value, and investor B buys closed-end shares at 85% thereof, plus 1.5% commission. Both sets of shares earn and pay 30% of this asset value in, say, 4 years, and end up with the same value as at the beginning. Investor A redeems his shares at 100% of value, losing the 9% premium he paid. His overall return for the period is 30% less 9%, or 21% on asset value. This, in turn, is 19% on his investment. How much must investor B realize on his closed-end shares to obtain the same return on his investment as investor A? The answer is 73%, or a discount of 27% from asset value. In other words, the closed-end man could suffer a widening of 12 points in the market discount, about double, before his return would get down to that of the open-end investor. An adverse change of this magnitude has happened rarely, if ever, in the history of closed-end shares. Hence, it is very unlikely that you will obtain a lower overall return from a representative closed-end company, bought at a discount, if its investment performance is about equal to that of a representative mutual fund. If a small load or no load fund is substituted for one with the usual 8.5% load, the advantage of the closed-end investment is of course reduced, but it remains an advantage. The fact that a few closed-end funds are selling at premiums greater than the true 9% charge on most mutual funds introduces a separate question for the investor. Do these premium companies enjoy superior management of sufficient proven worth to warrant their elevated prices? If the answer is sought in the comparative results for the past 5 or 10 years, the answer would appear to be no. 3 of the 6 premium companies have mainly foreign investments. A striking feature of these is the large variation in prices in a few years' time. At the end of 1970, one sold at only 1/4 of its high, another at 1/3, another at less than half. If we consider the 3 domestic companies selling above asset value, we find that the average of their 10-year overall returns was somewhat better than that of 10 discount funds. But the opposite was true in the last 5 years. A comparison of the 1961 through 1970 record of Lehman Corporation and of General American Investors, 2 of our oldest and largest closed-end companies, is given in Table 9.5. Take a look at it on the enhancement. One of these sold 14% above, and the other 7.6% below its net asset value at the end of 1970. The difference in price to net asset relationships did not appear warranted by these figures. Investment in balanced funds. The 23 balanced funds covered in the Weisenberger report had between 25% and 59% of their assets in preferred stocks and bonds, the average being just 40%. The balance was held in common stocks. It would appear more logical for the typical investor to make his bond-type investments directly, rather than to have them form part of a mutual fund commitment. The average income return shown by these balanced funds in 1970 was only 3.9% per annum on asset value, or say 3.6% on the offering price. The better choice for the bond component would be the purchase of United States savings bonds, or corporate bonds rated A or better, or tax-free bonds, for the investor's bond portfolio. Commentary on Chapter 9. The school teacher asks Billy Bob, "If you have 12 sheep and one jumps over the fence, how many sheep do you have left?" Billy Bob answers, "None." "Well," says the teacher, "you sure don't know your subtraction." "Maybe not," Billy Bob replies, "but I darn sure know my sheep." An old Texas joke. Almost perfect. A purely American creation, the mutual fund was introduced in 1924 by a former salesman of aluminum pots and pans named Edward G. Loeffler. Mutual funds are quite cheap, very convenient, generally diversified, professionally managed, and tightly regulated under some of the toughest provisions of federal securities law. By making investing easy and affordable for almost anyone, the funds have brought some 54 million American families, and millions more around the world, into the investing mainstream, probably the greatest advance in financial democracy ever achieved. But mutual funds aren't perfect. They are almost perfect, and that word makes all the difference. Because of their imperfections, most funds underperform the market, overcharge their investors, create tax headaches, and suffer erratic swings in performance. The intelligent investor must choose funds with great care in order to avoid ending up owning a big fat mess. Top of the charts. Most investors simply buy a fund that has been going up fast on the assumption that it will keep on going. And why not? Psychologists have shown that humans have an inborn tendency to believe that the long run can be predicted from even a short series of outcomes. What's more, we know from our own experience that some plumbers are far better than others, that some baseball players are much more likely to hit home runs, that our favorite restaurant serves consistently superior food, and that smart kids get consistently good grades. Skill and brains and hard work are recognized, rewarded, and consistently repeated all around us. So if a fund beats the market, our intuition tells us to expect it to keep right on outperforming. Unfortunately, in the financial markets, luck is more important than skill. If a manager happens to be in the right corner of the market at just the right time, he will look brilliant. But all too often, what was hot suddenly goes cold, and the manager's IQ seems to shrivel by 50 points. Figure 9.1, found on the enhancement, shows what happened to the hottest funds of 1999. This is yet another reminder that the market's hottest market sector, in 1999 that was technology, often turns as cold as liquid nitrogen, with blinding speed and utterly no warning. And it's a reminder that buying funds based purely on their past performance is one of the stupidest things an investor can do. Financial scholars have been studying mutual fund performance for at least a half-century, and they are virtually unanimous on several points. The average fund does not pick stocks well enough to overcome its costs of researching and trading them. The higher a fund's expenses, the lower its returns. The more frequently a fund trades its stocks, the less it tends to earn. Highly volatile funds, which bounce up and down more than average, are likely to stay volatile. Funds with high past returns are unlikely to remain winners for long. Your chances of selecting the top-performing funds of the future on the basis of their returns in the past are about as high as the odds that Bigfoot and the abominable snowman will both show up in pink ballet slippers at your next cocktail party. In other words, your chances are not zero, but they're pretty close. But there's good news, too. First of all, understanding why it's so hard to find a good fund will help you become a more intelligent investor. Second, while past performance is a poor predictor of future returns, there are other factors that you can use to increase your odds of finding a good fund. Finally, a fund can offer excellent value even if it doesn't beat the market, by providing an economical way to diversify your holdings, and by freeing up your time for all the other things you would rather be doing than picking your own stocks. The first shall be last. Why don't more winning funds stay winners? The better a fund performs, the more obstacles its investors face. Migrating managers. When a stock picker seems to have the Midas touch, everyone wants him, including rival fund companies. If you bought Transamerica Premier Equity Fund to cash in on the skills of Glenn Bickerstaff, who gained 47.5% in 1997, you were quickly out of luck. TCW snatched him away in mid-1998 to run its TCW Galileo Select Equities Fund, and the Transamerica Fund lagged the market in 3 of the next 4 years. If you bought Fidelity Aggressive Growth Fund in early 2000 to capitalize on the high returns of Erin Sullivan, who had nearly tripled her shareholders' money since 1997, oh well, she quit to start her own hedge fund in 2000, and her former fund lost more than 3/4 of its value over the next 3 years. Asset elephantiasis. When a fund earns high returns, investors notice, often pouring in hundreds of millions of dollars in a matter of weeks. That leaves the fund manager with few choices, all of them bad. He can keep that money safe for a rainy day, but then the low returns on cash will crimp the fund's results if stocks keep going up. He can put the new money into the stocks he already owns, which have probably gone up since he first bought them, and will become dangerously overvalued if he pumps in millions of dollars more. Or he can buy new stocks he didn't like well enough to own already, but he will have to research them from scratch and keep an eye on far more companies than he's used to following. Finally, when the $100 million Nimble Fund puts 2% of its assets, or $2 million, in Minnow Corporation, a stock with a total market value of $500 million, it's buying up less than 0.5% of Minnow. But if hot performance swells the Nimble Fund to $10 billion, then an investment of 2% of its assets would total $200 million, nearly half the entire value of Minnow, a level of ownership that isn't even permissible under federal law. If Nimble's portfolio manager still wants to own small stocks, he'll have to spread his money over vastly more companies, and probably end up spreading his attention too thin. No more fancy footwork. Some companies specialize in incubating their funds, test driving them privately before selling them publicly. Typically, the only shareholders are employees and affiliates of the fund company itself. By keeping them tiny, the sponsor can use these incubated funds as guinea pigs for risky strategies that work best with small sums of money, like buying truly tiny stocks or rapid-fire trading of initial public offerings. If its strategy succeeds, the fund can lure public investors en masse by publicizing its private returns. In other cases, the fund manager waives or skips charging management fees, raising the net return, then slaps the fees on later after the high returns attract plenty of customers. Almost without exception, the returns of incubated and fee-waived funds have faded into mediocrity after outside investors poured millions of dollars into them. Rising expenses. It often costs more to trade stocks in very large blocks than in small ones. With fewer buyers and sellers, it's harder to make a match. A fund with $100 million in assets might pay 1% a year in trading costs. But if high returns send the fund mushrooming up to $10 billion, its trades could easily eat up at least 2% of those assets. The typical fund holds onto its stocks for only 11 months at a time, so trading costs eat away at returns like a corrosive acid. Meanwhile, the other costs of running a fund rarely fall, and sometimes even rise as assets grow. With operating expenses averaging 1.5% and trading costs at around 2%, The typical fund has to beat the market by 3.5 percentage points per year before costs, just to match it after costs. Sheepish behavior. Finally, once a fund becomes successful, its managers tend to become timid and imitative. As a fund grows, its fees become more lucrative, making its managers reluctant to rock the boat. The very risks that the managers took to generate their initial high returns could now drive investors away and jeopardize all that fat fee income. So the biggest funds resemble a herd of identical and overfed sheep, all moving in sluggish lockstep, all saying "bah" at the same time. Nearly every growth fund owns Cisco and GE and Microsoft and Pfizer and Walmart, and in almost identical proportions. This behavior is so prevalent that finance scholars simply call it herding. But by protecting their own fee income, fund managers compromise their ability to produce superior returns for their outside investors. Because of their fat costs and bad behavior, most funds fail to earn their keep. No wonder high returns are nearly as perishable as unrefrigerated fish. What's more, as time passes, the drag of their excessive expenses leaves most funds farther and farther behind, as Figure 9.2 shows. Take a look at it on the enhancement. What then should the intelligent investor do? First of all, recognize that an index fund, which owns all the stocks in the market all the time without any pretense of being able to select the best and avoid the worst, will beat most funds over the long run. If your company doesn't offer a low-cost index fund in your 401k, organize your coworkers and petition to have one added. It's rock-bottom overhead, operating expenses of 0.2% annually, and yearly trading costs of just 0.1%. Give the index fund an insurmountable advantage. If stocks generate, say, a 7% annualized return over the next 20 years, a low-cost index fund like Vanguard Total Stock Market will return just under 6.7%. That would turn a $10,000 investment into more than $36,000. But the average stock fund, with its 1.5% in operating expenses and roughly 2% in trading costs, will be lucky to gain 3.5% annually. That would turn $10,000 into just under $20,000, or nearly 50% less than the result from the index fund. Index funds have only one significant flaw. They're boring. You'll never be able to go to a barbecue and brag about how you own the top-performing fund in the country. You'll never be able to boast that you beat the market because the job of an index fund is to match the market's return, not to exceed it. Your index fund manager is not likely to roll the dice and gamble that the next great industry will be teleportation or scratch-and-sniff websites or telepathic weight loss clinics. The fund will always own every stock, not just one manager's best guess at the next new thing. But as the years pass, the cost advantage of indexing will keep accruing relentlessly. Hold an index fund for 20 years or more, adding new money every month, and you're all but certain to outperform the vast majority of professional and individual investors alike. Late in his life, Graham praised index funds as the best choice for individual investors, as does Warren Buffett. Tilting the tables. When you add up all their handicaps, the wonder is not that so few funds beat the index, but that any do. And yet some do. What qualities do they have in common? Their managers are the biggest shareholders. The conflict of interest between what's best for the fund's managers and what's best for its investors is mitigated when the managers are among the biggest owners of the fund's shares. Some firms, like Longleaf Partners, even forbid their employees from owning anything but their own funds. At Longleaf and other firms like Davis and FPA, The managers own so much of the funds that they're likely to manage your money as if it were their own, lowering the odds that they'll jack up fees, let the funds swell to gargantuan size, or whack you with a nasty tax bill. A fund's proxy statement and statement of additional information, both available from the Securities and Exchange Commission through the EDGAR database at www.sec.gov, disclose whether the managers own at least 1% of the fund's shares. They're cheap. One of the most common myths in the fund business is that you get what you pay for, that high returns are the best justification for higher fees. There are two problems with this argument. First, it isn't true. Decades of research have proven that funds with higher fees earn lower returns over time. Secondly, high returns are temporary, while high fees are nearly as permanent as granite. If you buy a fund for its hot returns, you may well end up with a handful of cold ashes, but your costs of owning the fund are almost certain not to decline when its returns do. They dare to be different. When Peter Lynch ran Fidelity Magellan, he bought whatever seemed cheap to him, regardless of what other fund managers owned. In 1982, his biggest investment was Treasury bonds. Right after that, he made Chrysler his top holding, even though most experts expected the automaker to go bankrupt. Then, in 1986, Lynch put almost 20% of Fidelity Magellan in foreign stocks like Honda, Norsk Hydro, and Volvo. So, before you buy a U.S. stock fund, compare the holdings listed in its latest report against the roster of the S&P 500 index. If they look like Tweedledee and Tweedledum, shop for another fund. They shut the door. The best funds often close to new investors, permitting only their existing shareholders to buy more. That stops the feeding frenzy of new buyers who want to pile in at the top, and protects the fund from the pains of asset elephantiasis. It's also a signal that the fund managers are not putting their own wallets ahead of yours. But the closing should occur before, not after, the fund explodes in size. Some companies with an exemplary record of shutting their own gates are Longleaf, Numeric, Oakmark, T. Rowe Price, Vanguard, and Wasatch. They don't advertise. Just as Plato says in the Republic that the ideal rulers are those who do not want to govern, the best fund managers often behave as if they don't want your money. They don't appear constantly on financial television or run ads boasting of their number one returns. The steady little Mayors and Power Growth Fund didn't even have a website until 2001, and still sells its shares in only 24 states. The Touray Fund has never run a retail advertisement since its launch in 1990. What else should you watch for? Most fund buyers look at past performance first, then at the manager's reputation, then at the riskiness of the fund, and finally, if ever, at the fund's expenses. The intelligent investor looks at those same things, but in the opposite order. Since a fund's expenses are far more predictable than its future risk or return, you should make them your first filter. There's no good reason ever to pay more than these levels of annual operating expenses by fund category. Taxable and municipal bonds, 0.75%. U.S. equities, large and mid-sized stocks, 1%. High-yield junk bonds, 1%. U.S. equities, small stocks, 1.25%. Foreign stocks, 1.5%. Next, evaluate risk. In its prospectus, or buyer's guide, every fund must show a bar graph displaying its worst loss over a calendar quarter. If you can't stand losing at least that much money in 3 months, go elsewhere. It's also worth checking a fund's Morningstar rating. A leading investment research firm, Morningstar awards star ratings to funds based on how much risk they took to earn their returns. 1 star is the worst, 5 is the best. But just like past performance itself, these ratings look back in time. They tell you which funds were the best, not which are going to be. 5-star funds, in fact, have a disconcerting habit of going on to underperform 1-star funds. So first find a low-cost fund whose managers are major shareholders. Dare to be different. Don't hype their returns, and have shown a willingness to shut down before they get too big for their britches. Then, and only then, consult their Morningstar rating. Finally, look at past performance, remembering that it is only a pale predictor of future returns. As we've already seen, yesterday's winners often become tomorrow's losers. But researchers have shown that one thing is almost certain. Yesterday's losers almost never become tomorrow's winners. So avoid funds with consistently poor past returns, especially if they have above-average annual expenses. The closed world of closed-end funds. Closed-end stock funds, although popular during the 1980s, have slowly atrophied. Today, there are only 30 diversified domestic equity funds, many of them tiny, trading only a few hundred shares a day, with high expenses and weird strategies, like Morgan FundShares, which specializes in the stocks of habit-forming industries like booze, casinos, and cigarettes. Research by closed-end fund expert Donald Cassidy of Lipper Incorporated reinforces Graham's earlier observations. Diversified closed-end stock funds trading at a discount not only tend to outperform those trading at a premium, but are likely to have a better return than the average open-end mutual fund. Sadly, however, diversified closed-end stock funds are not always available at a discount in what has become a dusty, dwindling market. But there are hundreds of closed-end bond funds with especially strong choices available in the municipal bond area. When these funds trade at a discount, their yield is amplified, and they can be attractive, so long as their annual expenses are below the thresholds listed before. The new breed of exchange-traded index funds can be worth exploring as well. These low-cost ETFs sometimes offer the only means by which an investor can gain entree to a narrow market, like, say, companies based in Belgium or stocks in the semiconductor industry. Other index ETFs offer much broader market exposure. However, they are generally not suitable for investors who wish to add money regularly, since most brokers will charge a separate commission on every new investment you make. Know when to fold 'em. Once you own a fund, how can you tell when it's time to sell? The standard advice is to ditch a fund if it underperforms the market, or similar portfolios, for 1, or is it 2, or is it 3 years in a row? But this advice makes no sense. From its birth in 1970 through 1999, the Sequoia Fund underperformed the S&P 500 index in 12 out of its 29 years, or more than 41% of the time. Yet Sequoia gained more than 12,500% over that period, versus 4,900% for the index. The performance of most funds falters simply because the type of stocks they prefer temporarily goes out of favor. If you hired a manager to invest in a particular way, why fire him for doing what he promised? By selling when a style of investing is out of fashion, you not only lock in a loss, but you lock yourself out of the all but inevitable recovery. One study showed that mutual fund investors underperformed their own funds by 4.7 percentage points annually from 1998 through 2001, simply by buying high and selling low. So when should you sell? Here are a few definite red flags. A sharp and unexpected change in strategy, such as a value fund loading up on technology stocks in 1999, or a growth fund buying tons of insurance stocks in 2002. An increase in expenses, suggesting that the managers are lining their own pockets. large and frequent tax bills generated by excessive trading, suddenly erratic returns, as when a formerly conservative fund generates a big loss or even produces a giant gain. Why we love our Ouija boards. Believing, or even just hoping, that we can pick the best funds of the future makes us feel better. It gives us the pleasing sensation that we are in charge of our own investment destiny. This "I'm in control here" feeling is part of the human condition. It's what psychologists call overconfidence. Here are just a few examples of how it works. In 1999, Money magazine asked more than 500 people whether their portfolios had beaten the market. 1 in 4 said yes. When asked to specify their returns, however, 80% of those investors reported gains lower than the market's. 4% had no idea how much their portfolios rose, but were sure they had beaten the market anyway. A Swedish study asked drivers who had been in severe car crashes to rate their own skills behind the wheel. These people, including some the police had found responsible for the accidents, and others who had been so badly injured that they answered the survey from their hospital beds, insisted they were better than average drivers. In a poll taken in late 2000, Time and CNN asked more than 1,000 likely voters whether they thought they were in the top 1% of the population by income. 19% placed themselves among the richest 1% of Americans. In late 1997, a survey of 750 investors found that 74% believed their mutual fund holdings would consistently beat the Standard & Poor's 500 each year, even though most funds fail to beat the S&P 500 in the long run, and many fail to beat it in any year. While this kind of optimism is a normal sign of a healthy psyche, that doesn't make it good investment policy. It makes sense to believe you can predict something only if it actually is predictable. Unless you're realistic, your quest for self-esteem will end up in self-defeat. As the investment consultant Charles Ellis puts it, if you're not prepared to stay married, you shouldn't get married. Fund investing is no different. If you're not prepared to stick with a fund through at least 3 lean years, you shouldn't buy it in the first place. Patience is the fund investor's single most powerful ally. Chapter 10. The Investor and His Advisors. The investment of money in securities is unique among business operations, in that it is almost always based in some degree on advice received from others. The great bulk of investors are amateurs. Naturally, they feel that in choosing their securities, they can profit by professional guidance. Yet there are peculiarities inherent in the very concept of investment advice. If the reason people invest is to make money, then in seeking advice they are asking others to tell them how to make money. That idea has some element of naivete. Businessmen seek professional advice on various elements of their business, but they do not expect to be told how to make a profit. That is their own bailiwick. When they or non-business people rely on others to make investment profits for them, they are expecting a kind of result for which there is no true counterpart in ordinary business affairs. If we assume that there are normal or standard income results to be obtained from investing money in securities, then the role of the advisor can be more readily established. He will use his superior training and experience to protect his clients against mistakes and to make sure that they obtain the results to which their money is entitled. It is when the investor demands more than an average return on his money, or when his advisor undertakes to do better for him, that the question arises whether more is being asked or promised than is likely to be delivered. Advice on investments may be obtained from a variety of sources. These include 1. A relative or friend, presumably knowledgeable in securities. 2. A local commercial banker. 3. A brokerage firm or investment banking house. 4. A financial service or periodical. And 5. An investment counselor. The miscellaneous character of this list suggests that no logical or systematic approach in this matter has crystallized, as yet, in the minds of investors. Certain common sense considerations relate to the criterion of normal or standard results mentioned before. Our basic thesis is this: if the investor is to rely chiefly on the advice of others in handling his funds, then either he must limit himself and his advisors strictly to standard, conservative, and even unimaginative forms of investment, or he must have an unusually intimate and favorable knowledge of the person who is going to direct his funds into other channels. But if the ordinary business or professional relationship exists between the investor and his advisors, he can be receptive to less conventional suggestions only to the extent that he himself has grown in knowledge and experience, and has therefore become competent to pass independent judgment on the recommendations of others. He is then passed from the category of defensive or unenterprising investor into that of aggressive or enterprising investor. Investment counsel and trust services of banks. The truly professional investment advisors, that is, the well-established investment counsel firms who charge substantial annual fees, are quite modest in their promises and pretensions. For the most part, they place their clients' funds in standard interest and dividend-paying securities, and they rely mainly on normal investment experience for their overall results. In the typical case, it is doubtful whether more than 10% of the total fund is ever invested in securities other than those of leading companies, plus government bonds, including state and municipal issues. Nor do they make a serious effort to take advantage of swings in the general market. The leading investment counsel firms make no claim to being brilliant. They do pride themselves on being careful, conservative, and competent. Their primary aim is to conserve the principal value over the years and produce a conservatively acceptable rate of income. Any accomplishment beyond that, and they do strive to better the goal, they regard in the nature of extra service rendered. Perhaps their chief value to their clients lies in shielding them from costly mistakes. They offer as much as the defensive investor has the right to expect from any counselor serving the general public. What we've said about the well-established investment counsel firms applies generally to the trust and advisory services of the larger banks. Financial services. The so-called financial services are organizations that send out uniform bulletins, sometimes in the form of telegrams, to their subscribers. The subjects covered may include the state and prospects of business, the behavior and prospect of the securities markets, and information and advice regarding individual issues. There is often an inquiry department which will answer questions affecting an individual subscriber. The cost of the service averages much less than the fee that investment counselors charge their individual clients. Some organizations, notably Babson's and Standard & Poor's, operate on separate levels as a financial service and an investment counsel. Incidentally, other organizations such as Scudder, Stevens & Clark operate separately as investment counsel and as one or more investment funds. The financial services direct themselves on the whole to a quite different segment of the public than do the investment counsel firms. The latter's clients generally wish to be relieved of bother and the need for making decisions. The financial services offer information and guidance to those who are directing their own financial affairs or are themselves advising others. Many of these services confine themselves exclusively, or nearly so, to forecasting market movements by various technical methods. We shall dismiss these with the observation that their work does not concern investors, as the term is used in this audiobook. On the other hand, some of the best known, such as Moody's Investment Service and Standard & Poor's, are identified with statistical organizations that compile the voluminous statistical data that form the basis for all serious security analysis. These services have a varied clientele, ranging from the most conservative-minded investor to the rankest speculator. As a result, they must find it difficult to adhere to any clear-cut or fundamental philosophy in arriving at their opinions and recommendations. An old-established service of the type of Moody's and the others must obviously provide something worthwhile to a broad class of investors. What is it? Basically, they address themselves to the matters in which the average active investor-speculator is interested, and their views on these either command some measure of authority or at least appear more reliable than those of the unaided client. For years, the financial services have been making stock market forecasts without anyone taking this activity very seriously. Like everyone else in the field, they're sometimes right and sometimes wrong. Wherever possible, they hedge their opinions so as to avoid the risk of being proved completely wrong. There is a well-developed art of Delphic phrasing that adjusts itself successfully to whatever the future brings. In our view, perhaps a prejudiced one, this segment of their work has no real significance, except for the light it throws on human nature in the securities markets. Nearly everyone interested in common stocks wants to be told by someone else what he thinks the market is going to do. The demand being there, it must be supplied. Their interpretations and forecasts of business conditions, of course, are much more authoritative and informing. These are an important part of the great body of economic intelligence which is spread continuously among buyers and sellers of securities, and tends to create fairly rational prices for stocks and bonds under most circumstances. Undoubtedly, the material published by the financial services adds to the store of information available and fortifies the investment judgment of their clients. It is difficult to evaluate their recommendations of individual securities. Each service is entitled to be judged separately, and the verdict could properly be based only on an elaborate and inclusive study covering many years. In our own experience, we have noted among them a pervasive attitude which we think tends to impair what could otherwise be more useful advisory work. This is their general view that a stock should be bought if the near-term prospects of the business are favorable, and should be sold if these are unfavorable, regardless of the current price. Such a superficial principle often prevents the services from doing the sound analytical job of which their staffs are capable, namely to ascertain whether a given stock appears over or undervalued at the current price, in the light of its indicated long-term future earning power. The intelligent investor will not do his buying and selling solely on the basis of recommendations received from a financial service. Once this point is established, the role of the financial service then becomes the useful one of supplying information and offering suggestions. Advice from brokerage houses. Probably the largest volume of information and advice to the security-owning public comes from stockbrokers. These are members of the New York Stock Exchange and of other exchanges who execute buying and selling orders for a standard commission. Practically all the houses that deal with the public maintain a statistical or analytical department, which answers inquiries and makes recommendations. A great deal of analytical literature, some of it elaborate and expensive, is distributed gratis to the firm's customers, more impressively referred to as clients. A great deal is at stake in the innocent-appearing question whether customers or clients is the more appropriate name. A business has customers. A professional person or organization has clients. The Wall Street brokerage fraternity has probably the highest ethical standards of any business, but it is still feeling its way toward the standards and standing of a true profession. In the past, Wall Street has thrived mainly on speculation, and stock market speculators as a class were almost certain to lose money. Hence, it has been logically impossible for brokerage houses to operate on a thoroughly professional basis. To do that would have required them to direct their efforts toward reducing rather than increasing their business. The farthest that certain brokerage houses have gone in that direction, and could have been expected to go, is to refrain from inducing or encouraging anyone to speculate. Such houses have confined themselves to executing orders given them, to supplying financial information or analyses, and to rendering opinions on the investment merits of securities. Thus, in theory at least, they are devoid of all responsibility for either the profits or the losses of their speculative customers. Most stock exchange houses, however, still adhere to the old-time slogans that they are in business to make commissions, and that the way to succeed in business is to give the customers what they want. Since the most profitable customers want speculative advice and suggestions, the thinking and activities of the typical firm are pretty closely geared to day-to-day trading in the market. Thus, it tries hard to help its customers make money in a field where they are condemned almost by mathematical law to lose in the end. By this we mean that the speculative part of their operations cannot be profitable over the long run for most brokerage house customers. But to the extent that their operations resemble true investing, they may produce investment gains that more than offset the speculative losses. The investor obtains advice and information from stock exchange houses through two types of employees, now known officially as customers' brokers or account executives, and financial analysts. The customer's broker, also called a registered representative, formerly bore the less dignified title of customer's man. Today he is for the most part an individual of good character and considerable knowledge of securities, who operates under a rigid code of right conduct. Nevertheless, since his business is to earn commissions, he can hardly avoid being speculation-minded. Thus, the security buyer who wants to avoid being influenced by speculative considerations will ordinarily have to be careful and explicit in his dealing with his customer's broker. He will have to show clearly, by word and deed, that he is not interested in anything faintly resembling a stock market tip. Once the customer's broker understands clearly that he has a real investor on his hands, he will respect this point of view and cooperate with it. The financial analyst, formerly known chiefly as security analyst, is a person of particular concern to the author, who has been one himself for more than 5 decades and has helped educate countless others. At this stage, we refer only to the financial analysts employed by brokerage houses. The function of the security analyst is clear enough from his title. It is he who works up the detailed studies of individual securities, develops careful comparisons of various issues in the same field, and forms an expert opinion of the safety or attractiveness or intrinsic value of all the different kinds of stocks and bonds. By what must seem a quirk to the outsider, there are no formal requirements for being a security analyst. Contrast with this the facts that a customer's broker must pass an examination, meet the required character tests, and be duly accepted and registered by the New York Stock Exchange. As a practical matter, nearly all the younger analysts have had extensive business school training, and the oldsters have acquired at least the equivalent in the school of long experience. In the great majority of cases, the employing brokerage house can be counted on to assure itself of the qualifications and competence of its analysts. The customer of the brokerage firm may deal with the security analyst directly, or his contact may be an indirect one via the customer's broker. In either case, the analyst is available to the client for a considerable amount of information and advice. Let us make an emphatic statement here. The value of the security analyst to the investor depends largely on the investor's own attitude. If the investor asks the analyst the right questions, he is likely to get the right, or at least valuable, answers. The analysts hired by brokerage houses, we are convinced, are greatly handicapped by the general feeling that they are supposed to be market analysts as well. When they're asked whether a given common stock is sound, the question often means, is this stock likely to advance during the next few months? As a result, many of them are compelled to analyze with one eye on the stock ticker, a pose not conducive to sound thinking or worthwhile conclusions. In the next section of this audiobook, we shall deal with some of the concepts and possible achievements of security analysis. A great many analysts working for stock exchange firms could be of prime assistance to the bona fide investor who wants to be sure that he gets full value for his money, and possibly a little more. As in the case of the customer's brokers, what is needed at the beginning is a clear understanding by the analyst of the investor's attitude and objectives. Once the analyst is convinced that he's dealing with a man who is value-minded rather than quotation-minded, there is an excellent chance that his recommendations will prove of real overall benefit. The CFA Certificate for Financial Analysts. An important step was taken in 1963 toward giving professional standing and responsibility to financial analysts. The official title of Chartered Financial Analyst, CFA, is now awarded to those senior practitioners who pass required examinations and meet other tests of fitness. The subjects covered include security analysis and portfolio management. The analogy with the long-established professional title of Certified Public Accountant, CPA, is evident and intentional. This relatively new apparatus of recognition and control should serve to elevate the standards of financial analysts and eventually to place their work on a truly professional basis. Dealings with brokerage houses. One of the most disquieting developments of the period in which we write this revision has been the financial embarrassment, in plain words, bankruptcy, or near bankruptcy, of quite a few New York Stock Exchange firms, including at least two of considerable size. This is the first time in half a century or more that such a thing has happened, and it is startling for more than one reason. For many decades, the New York Stock Exchange has been moving in the direction of closer and stricter controls over the operations and financial condition of its members, including minimum capital requirements, surprise audits, and the like. Besides this, we have had 37 years of control over the exchanges and their members by the Securities and Exchange Commission. Finally, the stock brokerage industry itself has operated under favorable conditions, namely a huge increase in volume, fixed minimum commission rates, largely eliminating competitive fees, and a limited number of member firms. The first financial troubles of the brokerage houses in 1969 were attributed to the increase in volume itself. This, it was claimed, overtaxed their facilities, increased their overhead, and produced many troubles in making financial settlements. It should be pointed out this was probably the first time in history that important enterprises have gone broke because they had more business than they could handle. In 1970, as brokerage failures increased, they were blamed chiefly on the falling off in volume. A strange complaint when one reflects that the turnover of the NYSE in 1970 totaled 2,937 million shares, the largest volume in its history, and well over twice as large as in any year before 1965. During the 15 years of the bull market ending in 1964, the annual volume had averaged only 712 million shares, 1/4 of the 1970 figure. But the brokerage business had enjoyed the greatest prosperity in its history. If, as it appears, the member firms as a whole had allowed their overhead and other expenses to increase at a rate that could not sustain even a mild reduction in volume during part of a year, this does not speak well for either their business acumen or their financial conservatism. A third explanation of the financial trouble finally emerged out of a mist of concealment, and we suspect that it is the most plausible and significant of the three. It seems that a good part of the capital of certain brokerage houses was held in the form of common stocks owned by the individual partners. Some of these seem to have been highly speculative and carried at inflated values. When the market declined in 1969, the quotations of such securities fell drastically, and a substantial part of the capital of the firms vanished with them. In effect, the partners were speculating with the capital that was supposed to protect the customers against the ordinary financial hazards of the brokerage business, in order to make a double profit thereon. This was inexcusable. We refrain from saying more. The investor should use his intelligence not only in formulating his financial policies, but also in the associated details. These include the choice of a reputable broker to execute his orders. Up to now, it was sufficient to counsel our listeners to deal only with a member of the New York Stock Exchange, unless he had compelling reasons to use a non-member firm. Reluctantly, we must add some further advice in this area. We think that people who do not carry margin accounts, and in our vocabulary this means all non-professional investors, should have the delivery and receipt of their securities handled by their bank. When giving a buying order to your brokers, you can instruct them to deliver the securities bought to your bank, against payment therefor by the bank. Conversely, when selling, you can instruct your bank to deliver the securities to the broker against payment of the proceeds. These services will cost a little extra, but they should be well worth the expense in terms of safety and peace of mind. This advice may be disregarded, as no longer called for, after the investor is sure that all the problems of stock exchange firms have been disposed of, but not before. Investment bankers. The term investment banker is applied to a firm that engages to an important extent in originating, underwriting, and selling new issues of stocks and bonds. To underwrite means to guarantee to the issuing corporation or other issuer that the security will be fully sold. A number of the brokerage houses carry on a certain amount of underwriting activity. Generally, this is confined to participating in underwriting groups formed by leading investment bankers. There is an additional tendency for brokerage firms to originate and sponsor a minor amount of new issue financing, particularly in the form of smaller issues of common stocks, when a bull market is in full swing. Investment banking is perhaps the most respectable department of the Wall Street community, because it is here that finance plays its constructive role of supplying new capital for the expansion of industry. In fact, much of the theoretical justification for maintaining active stock markets, notwithstanding their frequent speculative excesses, lies in the fact that organized security exchanges facilitate the sale of new issues of bonds and stocks. If investors or speculators could not expect to see a ready market for a new security offered them, they might well refuse to buy it. The relationship between the investment banker and the investor is basically that of the salesman to the prospective buyer. For many years past, the great bulk of the new offerings in dollar value has consisted of bond issues that were purchased in the main by financial institutions such as banks and insurance companies. In this business, the security salesmen have been dealing with shrewd and experienced buyers. Hence, any recommendations made by the investment bankers to these customers have had to pass careful and skeptical scrutiny. Thus, these transactions are almost always effected on a business-like footing. But a different situation obtains in a relationship between the individual security buyer and the investment banking firms, including the stockbrokers acting as underwriters. Here, the purchaser is frequently inexperienced and seldom shrewd. He is easily influenced by what the salesman tells him, especially in the case of common stock issues, since often his unconfessed desire in buying is chiefly to make a quick profit, The effect of all this is that the public investor's protection lies less in his own critical faculty than in the scruples and ethics of the offering houses. It is a tribute to the honesty and competence of the underwriting firms that they are able to combine fairly well the discordant roles of advisor and salesman. But it is imprudent for the buyer to trust himself to the judgment of the seller. In 1959, we stated at this point, the bad results of this unsound attitude show themselves recurrently in the underwriting field, and with notable effects in the sale of new common stock issues during periods of active speculation. Shortly thereafter, this warning proved urgently needed. As already pointed out, the years 1960 through 61, and again 1968 through 69, were marked by an unprecedented outpouring of issues of lowest quality, sold to the public at absurdly high offering prices, and in many cases pushed much higher by heedless speculation and some semi-manipulation. A number of the more important Wall Street houses have participated to some degree in these less than credible activities, which demonstrates that the familiar combination of greed, folly, and irresponsibility has not been exorcised from the financial scene. The intelligent investor will pay attention to the advice and recommendations received from investment banking houses, especially those known by him to have an excellent reputation. But he will be sure to bring sound and independent judgment to bear upon these suggestions, either his own, if he is competent, or that of some other type of advisor. Other advisors. It is a good old custom, especially in the smaller towns, to consult one's local banker about investments. A commercial banker may not be a thoroughgoing expert on security values, but he is experienced and conservative. He is especially useful to the unskilled investor, who is often tempted to stray from the straight and unexciting path of a defensive policy, and needs the steadying influence of a prudent mind. The more alert and aggressive investor, seeking counsel in the selection of security bargains, will not ordinarily find the commercial banker's viewpoint to be especially suited to his own objectives. We take a more critical attitude toward the widespread custom of asking investment advice from relatives or friends. The inquirer always thinks he has good reason for assuming that the person consulted has superior knowledge or experience. Our own observation indicates that it is almost as difficult to select satisfactory lay advisors as it is to select the proper securities unaided. Much bad advice is given free. Summary. Investors who are prepared to pay a fee for the management of their funds may wisely select some well-established and well-recommended investment counsel firm. Alternatively, they may use the investment department of a large trust company or the supervisory service supplied on a fee basis by a few of the leading New York Stock Exchange houses. The results to be expected are in no way exceptional, but they are commensurate with those of the average, well-informed, and cautious investor. Most security buyers obtain advice without paying for it specifically. It stands to reason, therefore, that in the majority of cases they are not entitled to and should not expect better than average results. They should be wary of all persons, whether customers, brokers, or security salesmen, who promise spectacular income or profits. This applies both to the selection of securities and to guidance in the elusive and perhaps elusive art of trading in the market. Defensive investors, as we have defined them, will not ordinarily be equipped to pass independent judgment on the security recommendations made by their advisors, but they can be explicit, and even repetitiously so, in stating the kind of securities they want to buy. If they follow our prescription, they will confine themselves to high-grade bonds and the common stocks of leading corporations, preferably those that can be purchased at individual price levels that are not high in the light of experience and analysis. The security analyst of any reputable stock exchange house can make up a suitable list of such common stocks, and can certify to the investor whether or not the existing price level, therefore, is a reasonably conservative one as judged by past experience. The aggressive investor will ordinarily work in active cooperation with his advisors. He will want their recommendations explained in detail, and he will insist on passing his own judgment upon them. This means that the investor will gear his expectations and the character of his security operations to the development of his own knowledge and experience in the field. Only in the exceptional case, where the integrity and competence of the advisors have been thoroughly demonstrated, should the investor act upon the advice of others without understanding and approving the decision made. There have always been unprincipled stock salesmen and fly-by-night stockbrokers, and as a matter of course, we have advised our listeners to confine their dealings, if possible, to members of the New York Stock Exchange. But we are reluctantly compelled to add the extra cautious counsel that security deliveries and payments be made through the intermediary of the investor's bank. The distressing Wall Street brokerage house picture may have cleared up completely in a few years, but in late 1971, we still suggest better safe than sorry. Commentary on Chapter 10. I feel grateful to the Malaysian wench who, seeing the philosopher Thales continually spending his time in contemplation of the heavenly vault, and always keeping his eyes raised upward, put something in his way to make him stumble, to warn him that it would be time to amuse his thoughts with things in the clouds when he had seen to those at his feet. Indeed, she gave him or her good counsel, to look rather to himself than to the sky. Michel de Montaigne. Do you need help? In the glory days of the late 1990s, many investors chose to go it alone. By doing their own research, picking stocks themselves, and placing their trades through an online broker, these investors bypassed Wall Street's costly infrastructure of research, advice, and trading. Unfortunately, many do-it-yourselfers asserted their independence right before the worst bear market since the Great Depression, making them feel in the end that they were fools for going it alone. That's not necessarily true, of course. People who delegated every decision to a traditional stockbroker lost money too. But many investors do take comfort from the experience, judgment, and second opinion that a good financial advisor can provide. Some investors may need an outsider to show them what rate of return they need to earn on their investments, or how much extra money they need to save in order to meet their financial goals. Others may simply benefit from having someone else to blame when their investments go down. That way, instead of beating yourself up in an agony of self-doubt, you get to criticize someone who typically can defend him or herself and encourage you at the same time. That may provide just the psychological boost you need to keep investing steadily at a time when other investors' hearts may fail them. All in all, just as there's no reason you can't manage your own portfolio, so there's no shame in seeking professional help in managing it. How can you tell if you need a hand? Here are some signals. Big losses. If your portfolio lost more than 40% of its value from the beginning of 2000 through the end of 2002, then you did even worse than the dismal performance of the stock market itself. It hardly matters whether you blew it by being lazy, reckless, or just unlucky. After such a giant loss, your portfolio is crying out for help. Busted budgets. If you perennially struggle to make ends meet, have no idea where your money goes, find it impossible to save on a regular schedule, and chronically fail to pay your bills on time, then your finances are out of control. An advisor can help you get a grip on your money by designing a comprehensive financial plan that will outline how and how much you should spend, borrow, save, and invest. Chaotic portfolios. All too many investors thought they were diversified in the late 1990s because they owned 39 different internet stocks, or 7 different U.S. growth stock funds. But that's like thinking that an all-soprano chorus can handle singing Old Man River better than a soprano soloist can. No matter how many sopranos you add, that chorus will never be able to nail all those low notes until some baritones join the group. Likewise, if all your holdings go up and down together, you lack the investing harmony that true diversification brings. A professional asset allocation plan can help. Major changes. If you've become self-employed and need to set up a retirement plan, your aging parents don't have their finances in order, or college for your kids looks unaffordable, an advisor can not only provide peace of mind, but help you make genuine improvements in the quality of your life. What's more, a qualified professional can ensure that you benefit from and comply with the staggering complexity of the tax laws and retirement rules. Trust, then verify. Remember that financial con artists thrive by talking you into trusting them, and by talking you out of investigating them. Before you place your financial future in the hands of an advisor, it's imperative that you find someone who not only makes you comfortable, but whose honesty is beyond reproach. As Ronald Reagan used to say, trust, then verify. Start off by thinking of the handful of people you know best and trust the most. Then ask if they can refer you to an advisor whom they trust and who they feel delivers good value for his fees. A vote of confidence from someone you admire is a good start. Once you have the name of the advisor and his firm, as well as his specialty, is he a stockbroker, financial planner, accountant, insurance agent? You can begin your due diligence. Enter the name of the advisor and his or her firm into an internet search engine like Google to see if anything comes up. Watch for terms like fine, complaint, lawsuit, disciplinary action, or suspension. If the advisor is a stockbroker or insurance agent, contact the office of your state's securities commissioner. A convenient directory of online links is at www.nasaa.org to ask whether any disciplinary actions or customer complaints have been filed against the advisor. If you're considering an accountant who also functions as a financial advisor, your state's accounting regulators, whom you can find through the National Association of State Boards of Accountancy at www.nasba.org, will tell you whether his or her record is clean. Financial planners, or their firms, must register with either the U.S. Securities and Exchange Commission or securities regulators in the state where their practice is based. As part of that registration, the advisor must file a 2-part document called Form ADV. You should be able to view and download it at www.advisorinfo.sec.gov, www.iard.com, or the website of your state securities regulator. Pay special attention to the disclosure reporting pages, where the advisor must disclose any disciplinary actions by regulators. Because unscrupulous advisors have been known to remove those pages before handing an ADV to a prospective client, you should independently obtain your own complete copy. It's a good idea to cross-check a financial planner's record at www.cfp-board.org, since some planners who've been disciplined outside their home state can fall through the regulatory cracks. For more tips on due diligence, listen to the following sidebar. Words of warning. The need for due diligence doesn't stop once you hire an advisor. Melanie Center-Lubin, Securities Commissioner for the state of Maryland, suggests being on guard for words and phrases that can spell trouble. If your advisor keeps saying them, or twisting your arm to do anything that makes you uncomfortable, then get in touch with the authorities very quickly, warns Lubin. Here's the kind of lingo that should set off warning bells. Offshore. The opportunity of a lifetime. Prime bank. This baby's gonna move. Guaranteed. You need to hurry. It's a sure thing. Our proprietary computer model. The smart money is buying it. Option strategy. It's a no-brainer. You can't afford not to own it. We can beat the market. You'll be sorry if you don't. Exclusive. You should focus on performance, not fees. Don't you want to be rich? Can't lose. The upside is huge. There's no downside. I'm putting my mother in it. Trust me. Commodities trading. Monthly returns. Active asset allocation strategy. We can cap your downside. No one else knows how to do this. Getting to know you. A leading financial planning newsletter recently canvassed dozens of advisors to get their thoughts on how you should go about interviewing them. In screening an advisor, your goals should be to determine whether he or she cares about helping clients or just goes through the motions. Establish whether he or she understands the fundamental principles of investing as they are outlined in this audiobook. Assess whether he or she is sufficiently educated, trained, and experienced to help you. Here are some of the questions that prominent financial planners recommended any prospective client should ask. Why are you in this business? What is the mission statement of your firm? Besides your alarm clock, what makes you get up in the morning? What is your investing philosophy? Do you use stocks or mutual funds? Do you use technical analysis? Do you use market timing? A yes to either of the last two questions is a no signal to you. Do you focus solely on asset management, or do you also advise on taxes, estate and retirement planning, budgeting and debt management, and insurance? How do your education, experience, and credentials qualify you to give those kinds of financial advice? What needs do your clients typically have in common? How can you help me achieve my goals? How will you track and report my progress? Do you provide a checklist that I can use to monitor the implementation of any financial plan we develop? How do you choose investments? What investing approach do you believe is most successful? And what evidence can you show me that you have achieved that kind of success for your clients? What do you do when an investment performs poorly for an entire year? Any advisor who answers sell is not worth hiring. Do you, when recommending investments, accept any form of compensation from any third party? Why or why not? Under which circumstances? How much, in actual dollars, do you estimate I would pay for your services the first year? What would make that number go up or down over time? If fees will consume more than 1% of your assets annually, you should probably shop for another advisor. How many clients do you have, and how often do you communicate with them? What has been your proudest achievement for a client? What characteristics do your favorite clients share? What's the worst experience you've had with a client, and how did you resolve it? What determines whether a client speaks to you or to your support staff? How long do clients typically stay with you? Can I see a sample account statement? If you can understand it, ask the advisor to explain it. If you can't understand his explanation, he's not right for you. Do you consider yourself financially successful? Why? How do you define financial success? How high an average annual return do you think is feasible on my investments? Anything over 8% to 10% is unrealistic. Will you provide me with your resume, your Form ADV, and at least 3 references? If the advisor or his firm is required to file an ADV and he will not provide you a copy, get up and leave, and keep one hand on your wallet as you go. Have you ever had a formal complaint filed against you? Why did the last client who fired you do so. Defeating your own worst enemy. Finally, bear in mind that great financial advisors do not grow on trees. Often the best already have as many clients as they can handle, and may be willing to take you on only if you seem like a good match. So they will ask you some tough questions as well, which might include, why do you feel you need a financial advisor? What are your long-term goals? What has been your greatest frustration in dealing with other advisors, including yourself? Do you have a budget? Do you live within your means? What percentage of your assets do you spend each year? When we look back a year from now, what will I need to have accomplished in order for you to be happy with your progress? How do you handle conflicts or disagreements? How did you respond emotionally to the bear market that began in 2000? What are your worst financial fears? Your greatest financial hopes? What rate of return on your investments do you consider reasonable? Base your answer on Chapter 3. An advisor who doesn't ask questions like these, and who does not show enough interest in you to sense intuitively what other questions you consider to be the right ones, is not a good fit. Above all else, you should trust your advisor enough to permit him or her to protect you from your worst enemy, yourself. You hire an advisor, explains commentator Nick Murray, not to manage money, but to manage you. If the advisor is a line of defense between you and your worst impulsive tendencies, says financial planning analyst Robert Verez, then he or she should have systems in place that'll help the two of you control them. Among those systems, a comprehensive financial plan that outlines how you will earn, save, spend, borrow, and invest your money. An investment policy statement that spells out your fundamental approach to investing. An asset allocation plan that details how much money you'll keep in different investment categories. These are the building blocks on which good financial decisions must be founded, and they should be created mutually by you and the advisor, rather than imposed unilaterally. You should not invest $1 or make a decision until you are satisfied that these foundations are in place and in accordance with your wishes. Chapter 11. Security Analysis for the Lay Investor. General Approach. Financial analysis is now a well-established and flourishing profession, or semi-profession. The various societies of analysts that make up the National Federation of Financial Analysts have over 13,000 members, most of whom make their living out of this branch of mental activity. Financial analysts have textbooks, a code of ethics, and a quarterly journal. They also have their share of unresolved problems. In recent years, there's been a tendency to replace the general concept of security analysis by that of financial analysis. The latter phrase has a broader implication and is better suited to describe the work of most senior analysts on Wall Street. It would be useful to think of security analysis as limiting itself pretty much to the examination and evaluation of stocks and bonds, whereas financial analysis would comprise that work plus the determination of investment policy, portfolio selection, plus a substantial amount of general economic analysis. In this chapter, we shall use whatever designation is most applicable, with chief emphasis on the work of the security analyst proper. The security analyst deals with the past, the present, and the future of any given security issue. He describes the business. He summarizes its operating results and financial position. He sets forth its strong and weak points, its possibilities and risks. He estimates its future earning power under various assumptions, or as a best guess. He makes elaborate comparisons of various companies, or of the same company at various times. Finally, he expresses an opinion as to the safety of the issue, if it is a bond or investment-grade preferred stock, or as to its attractiveness as a purchase if it is a common stock. In doing all these things, the security analyst avails himself of a number of techniques, ranging from the elementary to the most abstruse. He may modify substantially the figures in the company's annual statements, even though they bear the sacred imprimatur of the certified public accountant. He is on the lookout particularly for items in these reports that may mean a good deal more or less than they say. The security analyst develops and applies standards of safety by which we can conclude whether a given bond or preferred stock may be termed sound enough to justify purchase for investment. These standards relate primarily to past average earnings, but they are concerned also with capital structure, working capital, asset values, and other matters. In dealing with common stocks, the security analyst until recently has only rarely applied standards of value as well defined as were his standards of safety for bonds and preferred stocks. Most of the time he contented himself with a summary of past performances, a more or less general forecast of the future, with particular emphasis on the next 12 months, and a rather arbitrary conclusion. The latter was, and still is, often drawn with one eye on the stock ticker or the market charts. In the past few years, however, much attention has been given by practicing analysts to the problem of valuing growth stocks. Many of these have sold at such high prices in relation to past and current earnings that those recommending them have felt a special obligation to justify their purchase by fairly definite projections of expected earnings running fairly far into the future. Certain mathematical techniques of a rather sophisticated sort have perforce been invoked to support the valuations arrived at. We shall deal with these techniques, in foreshortened form, a little later. However, we must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable. For the more dependent the valuation becomes on anticipations of the future, and the less it is tied to a figure demonstrated by past performance, the more vulnerable it becomes to possible miscalculation and serious error. A large part of the value found for a high multiplier growth stock is derived from future projections, which differ markedly from past performance, except perhaps in the growth rate itself. Thus, it may be said that security analysts today find themselves compelled to become most mathematical and scientific in the very situations which lend themselves least auspiciously to exact treatment. Let us proceed nonetheless with our discussion of the more important elements and techniques of security analysis. The present highly condensed treatment is directed to the needs of the non-professional investor. At the minimum, he should understand what the security analyst is talking about and driving at. Beyond that, he should be equipped, if possible, to distinguish between superficial and sound analysis. Security analysis for the lay investor is thought of as beginning with the interpretation of a company's annual financial report. This is a subject which we've covered for laymen in a separate book entitled The Interpretation of Financial Statements. We do not consider it necessary or appropriate to traverse the same ground in this chapter, especially since the emphasis in the present audiobook is on principles and attitudes rather than on information and description. Let us pass on two basic questions underlying the selection of investments. What are the primary tests of safety of a corporate bond or preferred stock? What are the chief factors entering into the valuation of a common stock? Bond analysis. The most dependable, and hence the most respectable, branch of security analysis concerns itself with the safety or quality of bond issues and investment-grade preferred stocks. The chief criterion used for corporate bonds is the number of times that total interest charges have been covered by available earnings for some years in the past. In the case of preferred stocks, it is the number of times that bond interest and preferred dividends combined have been covered. The exact standards applied will vary with different authorities. Since the tests are at bottom arbitrary, There is no way to determine precisely the most suitable criteria. In the 1961 revision of our textbook, Security Analysis, we recommend certain coverage standards, which